Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Bo Eckstein.
Thank you, Bo. How are you, brother?
I'm doing well. Just been busy on my lending business, and lots of borrowers are buying properties, and it's exciting. And there's so much construction going on right now too. So it's a really good time to be around. And even with COVID, obviously, the American people are very resilient, and we're going to overcome it. And so I think that, obviously we're being tested right now by God or somebody up there, but a lot of changes happening, a lot of things in political, world happening. But, I go on to LinkedIn and I'm kind of disgusted looking at all these people back and forth. So I chose not to really, take it to heart, because, I'm going to look at the facts and make decisions from the facts. And that's what I suggest everybody does, is really look at what the facts are and make your own decision from there. But I wish Americans right now would just kind of, stop bickering with each other, and really, we need to unite. And the people out there that are taking advantage of opportunities, because there's going to be a lot of opportunities here and in the future, those are the ones that are going to succeed. And I like I always say, I'm happy to come on Fridays, and always we interview fantastic guests.
Yes.
And we learn new things and learn skills, and we're investing our time and we're giving back to people. So I hope whoever's listening right now, take notes. It's going to be a good one.
I would say so, Bo. You're so right. I mean, the people who just have the right mindset, they've crushed it, in the last 5 months, 7 months, even during COVID. And there are a lot of people on the sideline who say, hey, it's going to get better in 2021, 2022. Guess what? You will stay outside the game, so you got to jump in. And it's so exciting. I mean, I don't want to brag or anything. I did 6 syndications in the last 7-8 months, collected $32.6 million, raised that much money, invested it all into different things. So it's all the mindset. It really is. And I hope everybody listening to us, please let us know where you're from. Go ahead and text us, or chat is the right to the Facebook channels. We can do it. I don't know if we can do it during the LinkedIn channels or the YouTube channels, because we are live in many, many channels coming to you. We have a great speaker today, great friend, Terry Judge, and I would love to introduce him. Hi, Terry. How are you, brother?
I'm doing great, Vinny. So happy to be on your show finally. This is awesome.
Thank you. No, Terry is amazing. Terry Judge is the founder and CEO of Core Solutions Group, LLC. He's the visionary behind the brand and the oversees much of the growth and the strategic business planning. Terry has an extensive entrepreneurship background with over 25 years in business ownership, and is one of the early adopters of the engineering-based cost segregation. We're going to talk about cost segregation to save you guys billions or millions or billions of dollars, business partnership, early adopters, and as well as other highly specialized tax credit and incentive strategies. So I'm going to read it here a little bit more. He has a passion for educating people in the commercial and multifamily space on how to maximize cash flow and take full advantage of the ever-changing tax code. Terry speaks nationally and has published several white papers on the magic of cost segregation. Terry has both a tax and engineering background, and over the last 15 years, along with his team, have developed thousands of engagements that have yielded over billions of dollars, guys. You got to listen to this one, in net tax savings. Today, Terry and his firm, Core Solutions Group, are blessed to work with so many of the top accounting and real estate firms, as well as the brand new investors who just purchased their first multifamily investment property. Terry is a firm believer in giving back and supports several local charities in Detroit through its newly formed charitable arm called Core Cares. Welcome, Terry. Really love to, if you would kind of tell us your background and how you got into this business, things like that, so that our audience will know.
Well, for sure, and I'm so blessed to be here and love what you guys are doing and what you're up to, Vinny, and your motivation and your inspiration is just, it just keeps driving. And I think, we had to double down this year. It was kind of such a year of uncertainty, but just such a year of growth. For those that didn't, say, oh, I'm going to wait till after the election, or, oh, I'm going to wait till the COVID stops, are the ones that I think missed out on some serious opportunities. And, right now, we're busy. We're expanding, we're exploding, we're investing in real estate. And I said, we got to trust ourselves and our own abilities just to move forward. But, Vinny, to answer your question, I started this company 15 years ago, hence the white hair now and all that, all that stuff. We started as an engineering firm. We got into, I used to be I'm in the energy space as well. So I had two energy companies. And so I had a background of engineering, not so much the tax side. And I saw that I learned about cost segregation, 15 years ago when very few people were doing it.
Yeah.
And I just got so fascinated, and I learned that there was such a hole, or just such a gap in the market. Very few real estate investors were really leveraging or utilizing this type of strategy, and they were writing their buildings off, over the long term. And then when I kind of started getting my arms around this, we decided to start Core Solutions Group specifically for cost segregation. And we started working with CPAs. And one of the things we learned very quickly too is that the CPA community, obviously understand depreciation intimately, but they didn't have the engineering background or the legal background to actually feel comfortable to offer cost segregation. And therefore it was left off the table, or always an afterthought. And I couldn't believe how few people were actually taking advantage of this. So, I started to speak on the subject, and we started to grow the firm, and slowly but surely we started adding other specialty tax services for commercial real estate investors. So fast forward today, like you said, Vinny, thousands of projects around the country. So happy to be helping people today with improving cash flow, especially because of COVID. And I'm still kind of, there's still a big, even today, it's still being missed or underutilized on how to capture these tax incentives, because now it's because of all of the tax incentives, like the CARES Act that recently passed through COVID, the Tax Cuts and Jobs Act. There are layers of cost segregation when you buy a property or when you dispose of a property. And, it's very, very important, whether it's our firm or another firm, they really have a good grip on all of the ways to maximize cost segregation, because it really has become more of a sophisticated tool, as you know, and it has created over billions of dollars now for our clients. So we're super excited to be partnering with you guys.
In simple terms, Terry, let's see, somebody listening to us, what is cost segregation?
Yeah, it's got a crazy name. It's got a bad name. Like, segregation is not a good name, a good word in today's society. So I'm trying to change the name and recoin it to cost allocation studies.
Yeah.
I like that a lot better than segregation.
Yeah.
Anyway, so there's two pathways. Let me just say this, and I'll keep it very simple, and we can elaborate it. But there's two pathways in the tax code. One is the straight line method, which you're going to write a building off over the long term, 27 and a half years for multifamily, 39 years for other commercial assets. And that's fine. And then there's another pathway in the tax code, which is the IRS allows a very rapid depreciation schedule where we can break apart components of the building, mechanical, plumbing, wiring, irrigation, on and on, all the interior build outs, the exterior land improvements. And those can be written off over a much shorter span. Therefore, front loading all that depreciation in today's dollars, creating the magic of time value of money. And I tell my clients, I'm like, when I'm explaining this, like, why would you want to leave the money in the IRS's pocket when you can put it in Vinny's pocket or Bo's pocket or my pocket or our client's pocket?
Yeah.
Why would you not leverage that? It's in the tax code since the late 60s, and it's gone through all these flavors, and it's been really the gift that keeps on giving because it keeps getting enhanced. And we can talk about some of those enhancements here on the show, but
sure.
But so that's in a nutshell, to keep it very simple. We're breaking apart hundreds of components that make up a big cost of that acquisition or new construction piece. We go right behind the walls. We pluck off right down to the electrical jacks, the wiring behind the walls, non-load bearing walls, drop ceilings, raised floors, on and on and on and on. Where we can now write those assets off over a 5-year period in most cases. Versus a 27.5-year life.
And is it 5 and 15 and 27.5, or 10 is also there?
It goes, the major buckets are 5, 7, and 15-year life.
5, 7, 15.
Yeah. And now with bonus depreciation, obviously it's another game changer through some of these improved tax legislations.
Is going away, I heard. Is that right? Or
pardon me?
The bonus depreciation is only limited time, or
it phase out in 2023. And who knows what we'll have then? It's always ever changing. Yeah. So right now, we're telling our clients, take advantage of this bonus depreciation. And what that means is, instead of waiting 15 years or 5 years, now the IRS says, we're just going to swoop it to 1 year.
Yeah.
And you now are literally writing off your down payment for a property, because on $1 million building, that could generate upwards of $300,000 now with bonus depreciation. So as your investors are coming in or you're buying buildings, let's say it's a $1 million building, so you got to come up with, let's say, $250,000. You're literally, your first year benefit doing a cost segregation study could be $250,000 to $300,000. I mean, it's just like a no-brainer.
So like 25 to 30% of the equity or the price, right? So like, if we're looking at this, and can this be done on an existing building the same way as new construction, or does it have to? Okay.
Yep.
So essentially, and also here's my other question. Like, if I didn't need the write-offs, but I was bringing in a high net worth person into a deal, is there a way that, even though the ownership is 50-50, that they can take all of the write-offs? I'm just curious.
Well, so it depends on if they're passive or active in the deal, but they are going to get passive write-offs against passive write-offs. So if they're just an investor, they can definitely benefit on their K1s to take that depreciation for sure. If active investors, which is this is pretty awesome, where you can now use the depreciation for one property to offset income off of other properties or W-2 wages. And, for people that are starting to invest, when you think about that, that could be the difference between them leaving their W-2 job much faster, because now they're able to write off so much more income tax, which obviously creates more money in the household. And, so it's a very powerful leveraging tool, just based on the situation.
Yeah, I mean, I think this is so powerful because there's a lot. I'm thinking of one of my a contact of mine, and he's a high-paid W-2 employee, has no write-offs. I mean, he makes between, I don't know, anywhere from $800 to $1 million a year W-2. Wow. So he's getting clobbered, right? But he's not a real estate guy,
right?
And so how do we get this information in front of a guy like this guy and say, here, invest in a vehicle like this, even as a limited partner, and get K1s, and then take this invest $500,000, and this is what your allocation would look like, right? Like, how do we show that to somebody before they actually close on a deal, like kind of like a pro forma of what their anticipated tax benefits would be?
That's a great comment and question, all wrapped into one, because every time you're looking at going and investing into a building, a lot of times the cost segregation piece is kind of left out of the equation. And I'm starting to see it more and more. Yeah, in the line items, you can actually show what the cost segregation first year, benefit would be. And then based on the percentage of ownership with the people that are investing, they're going to get the same piece whatever their piece of the ownership of the building is, that's the amount of depreciation that they're going to get back on their K1. So it's still, and then year over year, they're getting those write-offs as they're invested in that property. So
as I understand, Terry, like for example, if there is a limited partner, it's a passive loss for them on their K1. Like for example, the 35 million deal that we bought in December, my $100,000 investor got minus 61,000 on their K1 in that second box, rental income, passive income loss or like that. But because they are limited, it's a passive loss for them. It cannot back against their W-2 income, right, as I understand it. Is that right? Yeah.
Yes, that is correct. Yeah, you can only take it against passive. So you'd have to, then eventually you figure out, okay, I want to become an active investor. Obviously, that's just more hours doing deals, looking at deals, analyzing deals. You're getting involved more maybe on the GP side. So you're taking a bigger role, obviously, but you can become an active investor. It's just there's some documentation, get with your CPA. But then again, it just really kind of the cap comes off, and you can really now, your friend that's a high net worth individual. That's what's so beautiful about what you guys are doing and bringing in W-2 earners to start to invest in. That's what I'm doing as an owner of a company. Obviously, I'm paying myself. I'm paying ordinary income tax. Yeah. I'm making good income, and I want to now invest some of that money back as I'm learning from you guys. I'm starting to invest this year, just saying I'm just going for it. And I've invested in a couple syndications, and Vinny, I got to start talking about your upcoming deal. So very exciting, man. I want to align with people that are already doing it. I want to learn from you guys. So it's awesome.
Surely, Terry. Other thing also I read, and maybe it's true, is that anybody who did not take cost segregation, they can recapture it for the last 5 years. If you have owned the property for 2, 3, 4, 5 years, you could recapture. Is that still true?
So there's two things within that. So first of all, in the regular normal tax code world with cost segregation, we can actually go back to, check this out, 1987 legally. So if you've owned a property, you've been sitting on a property, maybe, no one's ever brought cost segregation to you. They never understood it. Maybe they had a CPA that was old school.
Yeah.
Now, we don't go back to 87 anymore because that property's been completely depreciated, but we will go back to the mid-90s.
Oh, wow.
Early 2000s. Let's just say 2000. Sorry, that's going back too far, mid-90s. Let's just say 2000 realistically.
It's almost 20 years.
Well, yes. And then we can do a look-back study. We file what's called a 481 adjustment. The IRS allows a one-time automatic consent.
Wow.
That you can take all this back depreciation in today's tax year. So let's say 2020.
Wow.
And then you have a 20-year carry forward in addition to that.
Holy cow. Holy cow. Wow.
That's number one. So that's just, we do that day in and day out. Our CPA partners bring us in. We do all the calculations. We hand it off to them, and then they take it and incorporate it into their clients' situation. The other way is what came out in the CARES Act, which is the net operating loss rule, which means you can take cost segregation, create depreciation. You can carry it back 5 years that you said, Vinny. And then, and then you can, so that now you would be amending a return for whichever year. But if you had a high, you'll say you made a lot of money that year, you can pull back the depreciation, file for the refund, amend that return, and then you can get a tax return on that. So that is still in play. And for those of you that own buildings and are generating depreciation this year, get with your accountant and talk to them about the new NOL rule through the CARES Act.
Go ahead, Bo.
Oh yeah, somebody just asked, can you do this on like an owner-occupied property, or it's got to be investment? Can you accelerate depreciation on an owner-occupied property?
Yeah, so we're starting to do a lot of single-family rental homes, but we're doing them as a block. So economically, it doesn't make sense to do one-offs. Mm-hmm. However, we just did one. One of our clients, young guy, had 13 residential homes. Wow. We showed him cost seg. He was blown away. We got him about on 13 homes. I think the tax benefit was $250,000.
Wow.
And as long as we have a collective basis of about 500,000, that's the magic number right now. So for those of you that are buying duplexes, fourplexes, you're getting started, your purchase price is, let's say under $1 million, and maybe you're thinking, oh, you're too small for cost segregation. Well, because of some of the new enhancements and all the new little tax caveats that have taken place over the last 18 months, it now is about $500,000 and up. So
that's fantastic, because I, obviously I'm in lending, but I have a lot of clients that own large portfolios. I got a guy that owns 150 single family rentals in California, and this is going to create so much opportunity, because the way I'm looking at it too is how can I get investors, right? Like the investors, and I want to go back to a question. So if they're an LP, it's different than a GP. So even if they're not, and I know you're not a CPA, well, you might be, you're an engineer, and you're not a CPA though. Right. So
I'm not a CPA by training.
You're an engineer and a couple other things, but not a CPA. So always ask your CPA, and Terry probably has referrals for this. But the question here is, let's say, if it wasn't a syndication deal where we got GP, LP side, it's just a smaller deal. I wanted to go out and acquire a portfolio of 50 houses, let's say. Could I bring a non-real estate professional into the GP side, and then if they're in the GP side, they could actually, it's not a passive loss, it'd be an active loss, and then they could write it off against their W-2 hypothetically, or do they have to be classified as a real estate professional if they're on the GP side? That's kind of a complicated question.
Yeah, you still got to be an active investor in the scheme of things. Now, I would say get counsel from a CPA, because if you're going to bypass the rule, there's some gray area around this. We're not CPA, so we kind of, we do all the engineering calculations, we put everything together, and there's a certain line that we don't cross, but we like to refer certain things back. So jumping into a GP, you're going to be you're obviously, as a GP, you're going to be doing more, you're going to have more responsibilities in the deal. You're not a passive investor anymore, but you still have to accumulate the hours that constitute if you're going to do it legitimately.
Right. But I see a huge opportunity, and because there's so many, I'm seeing so many doctors and high net worth people that are like, okay, I need to start getting into real estate, and I need to start clocking my hours. So maybe their spouse could get the real estate license and they could start going and docking their time for, even as a limited partner. I don't know. I'd love to we should get a CPA on too, so we can.
Yeah, we should.
I have a CPA. I'm in-house. That is unbelievable, and he's always involved, always interacting.
Yeah.
So two CPAs talking, and I kind of take a. But we can do deep dives on all this stuff, because it's very key. Especially, we're even running people always ask me, not to move too quick off your subject, but even on recapture, when you're going to exit the building, there's planning around that, because when you sell, the IRS is going to want some of that money back. So there's we'll run a recapture analysis at no cost for our clients, and they'll say, hey, Terry, okay, I got this scenario. What if we buy a building for $1 million? We're going to put $200,000 into it. We think we can sell it for $2 million in 4 years. Would cost segregation benefit us or not? Because you still have that time value of money, and we'll run those analysis and kind of pinpoint. Normally, and just for the listeners, rule of thumb is about 3 to 5 years makes sense to do the cost segregation. If you're going to sell the building before 3 years, I would suggest not to do a cost segregation. And then the only other reason why you would not do a cost segregation would be if the building is not profitable. It's sitting during renovations. There's no tenants. There's no profit being kicked out. You don't need to do, unless you're going to use it specifically for another entity that you sold, or you need to. You have all this income that you're going to be paying ordinary income tax, Uncle Sam. Then you can use the cost seg on that building to move it to another property to maneuver, the write-offs. So those are the only two reasons why you would not want to do a cost seg study.
Sure. And it's the paper loss. Just to kind of let everybody know what depreciation is, a paper loss, as the whole LLC that owns the rental income, the property and everything, it's profitable. We are giving investors money, limited partners, general partners make money, but it's the paper loss, which is the depreciation, which gets elevated. Instead of doing straight line, today we are discussing cost allocation, like Terry said, so that we could differentiate taking the land out, because land does not depreciate.
Right.
So if it's a $10 million property, 20% is land, you got 8 million left. That 8 million can be divided in multifamily by 27.5. You take the same deduction each year, but better yet, you do cost allocation, breaking out all the different parts, components, the wiring, the flooring, the knobs, the everything, right, Terry? And that way we could depreciate that over 5 years, 7 years, 15 years, and 27.5 years. That way you could deduct that paper loss much faster. That will put your whole LLC in a negative. That's good for everybody.
Isn't that awesome? Yeah. And then the tenants are paying down the mortgage.
Yes.
Your building is appreciating, but you get to still kind of take this depreciation. So you're hitting it from all angles.
It's the best of the world.
The most powerful wealth building strategy on the planet. Everybody needs to be doing this.
Totally.
I don't know why it took me so long, Vinny, to get into this space. What is wrong with me?
Well, I think it's important too, as real estate investors. Vinny's been allocating this for a long time, but I think as real estate investors that are unaware of cost allocation / segregation, right?
Yes.
It's such an important tool to have somebody like Terry on your team that can they can size this up and say, is it feasible? Here's what you can look here. Here's a report. This is what it might look like for you if you invest in this deal, right? And so it's because it's for many high net worth people, it's really not about how much they're going to make on the deal. It's how much they're going to save in taxes is more important to a lot of people, right? If you have a ton of money, it's not really. It's really about what can you save tax wise, right? And that's almost just as important about the end of the day, what's your return, because they're paying such a high tax bracket.
So true, Bo. Also, Terry, please share. I know you have core solutions. It encompasses lots of other things along with cost, allocation. Would you like to expand on those for the audience?
Yeah. So we've, over the time, we've added some other value-based solutions around tax and around cost savings for our clients. We do property tax mitigation work for our clients as a kind of a value add if they need it. Uncapping is a real thing. Once the ownership changes hands, that property tax obviously can raise significantly and could kill deals.
Yep.
So we can come to the table and try to mitigate that. The other thing we do is on the energy side, we offer two energy at a federal level. A lot of people have never even heard of a program called 45L. And that is it's a dollar for dollar tax credit. It's a $2,000 tax credit per unit. As long as you've rehabbed the apartment complex or even a senior living, Vinny. There's some parameters around it. A lot of it revolves around building envelope, making sure that the envelope of the building is energy efficient. And then the HVAC, the heating and cooling in the building has to pass certain standards. And then that would qualify a $2,000 credit per unit. So, wow. And that's not depreciation. That's a dollar for dollar tax credit. That's even more impactful. And so that's one area. Then the other one is what it's called 179D. That's a federal program that came out back in 2005 under the Energy Policy Act. And that just basically means that if you've gone green, if you put in LED lighting, energy efficiency, HVAC, there's some layover here, crossover. Mechanical, HVAC, and building envelope lighting, you can qualify for up to $1.80 a square foot in the form of a tax break. And some of these go hand in hand with cost segregation. So when we are obviously some of the value, that we bring now is we're able to really do a deep dive due diligence and say, okay, what other areas, because some of those energy components are what we call real property. It has a long-term life. You are not able to accelerate the depreciation under cost segregation rules, because that's section 1250 property. Not to get too technical.
Yes.
But with the 179D and the 45L, they've added to, we're able to now pluck off even more components and be able to simply write those off. Well, the 45L is a straight tax credit. The 179D is more of another. It's another way of deducting and depreciating on top of the cost seg. It's another layer where we can double dip. So it just depends on a couple variables within that. I don't want to get too technical into the weeds, but we can also look at a lot of people that are building. And I know, Vinny, I know you're developing projects now. And with some of the codes and some of the ASHRAE standards, you're automatically going to be qualifying for some of these other the federal money.
Yeah, so true.
Yep. So
now, we just to PACE. I know my buddy Bo. I mean, he also is very much proficient in getting loans through PACE equity. Bo, is that right? I'll let you to kind of share with us. So Terry, is that something connected with Bo? I mean, Bo, no, PACE, or is it different?
Are you talking about some of the loans that you're doing, Bo, on the the green?
So we do CPACE financing. So in the capital stack, we get senior debt, and then through the assessment through, we do an energy engineering report. I don't know if you do that report for PACE per se, but anyways, in the capital stack right now with COVID, prior to COVID, we could get 80% going to a bank. And now the banks are saying, oh, I'm scared. I'm going to lend you 60% of cost on a construction. Well, now CPACE comes in and it fills the capital stack. So it's good for the developers. And it also, when they do their energy efficiency studies, right, like they're actually can document that the building's healthier and it's got a lot more energy efficiency, which is saving money, which is creating more value for the property. And you can use that on retrofit, meaning you could, take a building and add solar and add energy efficiencies, as you know. So it's a win-win. And right now, with so much construction going on, and then in the past, they would have to go out and they'd have to get senior debt and then go and get pref equity, which is like more expensive, in the capital stack. Well, that's what CPACE has done. Is CPACE comes in instead of pref equity, and it comes in and fills the void. So there's like 26 states that have approved the legislation. And so
we're involved in PACE, and it means property assessed clean energy for those of you that are listening in. But it's a great program. It's kind of tied into your property tax. It's long-term debt, so you can really your payback is a lot less than what you're saving. So you're in a delta. You're making money right out of the gate. You can keep your money in your pocket, just like you said, Bo. So in all that stuff, it just leads right into these federal energy programs. So once you've kind of done the due diligence on the capital stack and what you're talking about, it typically, not all the time, but a lot of time, it's automatically qualified for a company like ours to come in and do those energy federal programs. And it's just another another benefit sitting there that can improve the capital stack and the cash flow and the ROI, all the ROIs and all the good stuff.
That's so great. Terry, also I want audience to know that, there is a little bit cost involved in doing the cost allocation studies, but the rewards are immense. I mean, we're just leaving money on the table if we don't get these cost segregation, cost allocation, studies done. What kind of average cost would you like to share? Any numbers with the audience? It may cost for so much big business or building. It's going to be approximately blah blah. Or
you mean just the fees? Our fees?
Yeah, the fees. Yeah. Cost.
Yeah. So the fees in our space it's very affordable in terms of ROI. It's like it could be 20 to 1, 50 to 1 for terms of what you're going to get versus what we charge. So we go in, we'll take a look at the building size, how many floors, what's the acreage, is it garden style, there are things and variables that drive the cost, but it's 5 to 8, 9,000 depending upon the size of these deals. Obviously, if we're doing more work, we're adding energy efficiency, but those are separate engagements, obviously, but per project. But the impact, it's absolutely so affordable now.
Sure.
And I think people in the past were maybe, I don't want to pay, I don't want to pay this money to get this fee done. We're just going to take the normal depreciation. Because but now it's just because with bonus depreciation, the numbers are so staggering. You're getting, for every $1 million, let's say, here's some simple math for the listeners too. So for every $1 million generates about $250,000 in tax savings. So just kind of you can just do the math on how that can impact. And our fees don't drive up because of the bigger the number is. It is what it is. Our numbers are fixed. I wish it would drive up. So it's very economical now to have cost segregation studies.
I have a very good question, Terry. As you know, I'm also building down right here with my partner, senior living, ground ups, right? So it's land in the first year, then we build it. Now we are leasing it up. So in the second year, when we are already operational, how is this cost allocation can work for us in the second year, not the first year, because it was ground and we started framing.
Yeah, so the depreciation schedules are going to be tied to your date of occupancy for the most part. That's kind of a general rule. So once the building is now open for business, you're starting to put tenants into the building.
Yes.
So that's really when we would tie that date of occupancy. That would be technically the date we would start the depreciation schedules. But we can be engaged way earlier in the construction design phase, because my team can actually take a look at the way the building is being built, and there are other ways to design or maybe build that building that it becomes more cost segregation friendly.
I see.
Because a lot of people don't know there's a lot of what we call permanency rules in the IRS, and that's what drives cost segregation on what can be allocated versus what cannot be allocated, what can be written off versus what cannot be written off. And a lot of it is if something is removed, how much damage does it do? So there's certain ways to mount certain things that would then make it a 5-year asset versus a 27.5-year asset, just based on the way it's mounted and the way it's constructed.
Wow.
So there's certain things that we'll come in and do, and we'll take a look at the drawings, the designs. We'll kind of give some insight and input with the architecture and with you, and just see how we can improve or maximize. And maybe it's a few minor adjustments, which could add, could reduce the actual investment costs as well, because you're going to be getting more depreciation. So it's called pre-construction planning. We'll come in and we'll assist with you guys.
Awesome. So it has to be occupied. I agree. The day it opens, and then we got, like 3 residents, in senior living, it's a slow process. It's not
as soon as I think what I heard was as soon as you get certificate of occupancy, you could start depreciating it. So it doesn't matter the occupancy level, just that you have certificate of occupancy.
It's ready.
So year two, you can start taking that depreciation.
And I'll give you an example. Like we've had quite a few clients even this year where they bought a building, they're going to do a major gut and a major renovation. So, but they need depreciation in let's say 2020. The building's not really going to go into service into 21. Well, it's in service because they do have, let's say there's a tenant in there, or they're in there and they're starting to renovate, where then they can actually get some depreciation in 2020 on the as-built. So we'll carve out land improvements, things like that, and they might be able to use it to offset other income from another property, because these guys are active investors. And then so in 2021, then we finish the cost segregation. We call that phase 2, which is all the renovations. And then we get the final change orders, and then we finish up phase 2. So you can really, depending upon the tax year, the tax situation, every individual investor, has options based on what's going on in their life. we come in, we do a free no cost assessment. We say, okay, where are you at? What are you going to be spending? What are you removing? And then what are you going to be, how much money are you going to be putting back into the building? And let's see how this is going to play out.
So that's huge too, because we were talking about this a couple episodes ago.
Yeah.
And we're talking about adaptive reuse, which is a new trend, right? They're taking these old office buildings that have been vacant, and maybe they're in a historic, but people are taking these properties and they're putting them into a higher, better use today. So they're taking this office building, converting to multifamily. So you can get involved early, and then you could be kind of layering in, because they're going to be doing syndications on these type of deals too, right? To do these big adaptive reuse type deals, and there's going to be a lot of energy efficiency type products going in. So I think that's like the emerging market right now. Is like I'm seeing it more and more in the financing world. Is like people are coming to me and saying, "Oh, we're buying this and we're converting it to this." You're seeing it in old dilapidated hotels getting converted to multifamily. I mean, all this retail space, adaptive reuse, and that's where all this can kind of layer in. I can see it really growing.
Oh, growing for the next 5-10 years, I see it, because so much difference has, COVID has brought, and it has also made ourselves even more working from remotely, from anywhere, rather than in the structure and things like that. Totally. Now, let me take you also to hotels. As you know, I'm in hospitality also. We bought Hilton Garden Inn in Texas, and we're going to be buying more. Is it the cost segregation also very good in the hotels?
Oh, very, very good. Hotels are high finishes, high presentation. When you walk in, there's and because there's they've got the kitchen.
Yeah.
When you're designated as a hospitality, a sector, or like the restaurants, hotels qualify for this. There's even more cost allocation opportunities inside a senior living facility, let's say, in hotels, just as there are apartments, even more than apartments, actually, to be honest. Yeah, so senior living and hotels are fantastic. We've done quite a few of them over the years. So yeah, it's high return on cost segregation, because there's just so much that qualifies for shorter life property.
And it's very, very exciting, because I had my own CPA come to my mastermind class this week, Sheikh Ji, and he shared, which I knew it when I talked to him 6, 7, 8 months back, that in hotel profession, your active and passive income becomes the same, because you're looking at the P&L every day. Every day you're looking at it. So you're actually active in knowing what the ADR was, what was this and that. And that's according to the tax code, I think, that you could combine your active and passive income, which I love it. I mean, that's another way to really see that the loss in the hotel can bat against your W-2. Both, that's what I remember you were just talking about. But that's something I need to look more into it. But that's what I've understood, that active and passive income can be combined in that one, if you're general partners in the hotel, I have heard that. I want to talk to my internal CPA more specifically on that. And if it's just, that's phenomenal.
Yeah.
We would love to bring your, internal CPA, if you would like to, on one of our show next month or so, Terry. That'll be awesome. Amazing. What else can you tell us about, what new things might be coming with new administration? Any kind of things that are going to go away? What do you think?
So, it looks like Biden's going to be there. I know Trump's hanging in there. I'm not sure if it's going to be enough, but, so there's good. And, obviously in any presidential candidacy or administration, there's pros and cons. Trump did a lot of good things. Obviously, he did some things not so good. Biden's probably going to bring some things to the table, and he's going to probably bring some things not so good. As long as he does not mess with 1031 exchanges and depreciation, because he will tank the commercial real estate industry, because nobody will sell buildings anymore. And it'll that cycle of every 5 to 7 years, that creating that wealth for families, it's it would dry up. So we just hope that there's a lot of rich Democrats that have a lot of buildings and properties. And let me tell you something, they don't talk about it, but they freaking do cost segregation. They love cost segregation. And a lot of rich Republicans that love cost segregation. So we'll see. My whole thing is, as probably you guys know, we're all like biting I just want a balance of power. I think everybody just wants a balance of power. We have to hold on to the Senate. We'll be biting our nails till January 6th or 5th or whatever it is, the runoffs. And then I think we'll be okay. I think everything will kind of continue. Biden's going to have his hands full getting COVID under control. Like you said, Vinny, the vaccines are on its way. I think interest rates will remain very low for a while. I got clients buying stuff everywhere, every day right now. I mean, they're buying crap. I mean, not crap, but they're buying stuff. Sorry.
I know. And the interest rate, I just bought $35 million deal, right? 2 months back, 2.58%. Holy cow.
That's unbelievable.
I know, guys. 10-year fixed. It's amazing.
Yeah, that's beautiful. So we'll see. One of the things, obviously, if Biden, does become our next president, you're going to see a lot of green incentives, which is a good thing. There'll be a lot of, I think, renewable energy will explode. Green buildings. We've been in that game for 20 years. Yeah. So our company, and they'll be great. They'll probably be great. Are some new tax incentives. And maybe some new depreciation strategies because they're gonna drive that. They might take it from a little bit over here and maybe move it over here, but there'll be they're gonna incentivize guys like us to continue to do what we do. I hope that's what I'm a positive person too.
Yes.
There's gonna be opportunity no matter.
Positivity right there. Positivity brings profitability. Terry brought it up, buddy. Hey, again, thank you so much for coming on the show. It's been such a pleasure. I hope the audience got lots and lots of great nuggets. I know this whole podcast, it's going to become a podcast too, by the way. We do the live show in 7 channels or so, which is live. It's etched out there, but we'll also be putting it into podcast in Bo's channel, my channel. Terry, how can people reach you? Thanks for giving so good information.
Yeah, Vinny and Bo, I really appreciate you having me on. This has been a lot of fun. Hopefully the listeners got some value. I can be reached. You can, let's see. Let me give you my email. It's Terry Judge.
Sure.
Simple at coreadvisors.net.
Beautiful.
Yeah. And Vinny, let me just one thing real too quick because we're really excited about our partnership.
Yes.
We put together an affiliate model. We're sharing in the process. So if you refer business with Core, we're paying back. We now have the ability to you can get your cost segregation studies almost for free by just referring others that are going to need the service anyway. So we finally put together a program where we can partner with our clients and bring them into the fold and give them discounts. Just as a member now with Core, you're getting wholesale pricing on all of our services all throughout. And we have a whole marketplace of other services we didn't really touch on, Vinny, but maybe that'll be for another time, another show. Sure. And but Vinny can point you in the right direction for those of you that are listening that as far as cost segregation, all that stuff, or just reach out to me and we'll connect all the dots and make the magic happen and take care of your listeners. And I love it.
Totally. And I hope everybody who's listening, guys, please look into it. Google the word, cost segregation, cost allocation. You will save a bundle of money and your investors would love, like my investors for the last 14 years have been loving me, because I've saved them tons and tons and tons of money and so on. And you can reach me at vinnychopra.com. I'm all over the internet. Many of you know, and our Bo, my friend Bo, who is a great loan broker. He's doing business like crazy. That's awesome. All kind of fields. So we really love to come to you live every Friday. Remember, it's 9:30. Put the notification on. Please like our show, share it, like it, comment, give all those things. Terry, thank you so much, buddy.
Thanks, guys. I appreciate it. I had fun.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.